What if I told you that the money sitting in your bank account, in your retirement funds, or even invested in seemingly liquid assets isn't truly yours? For decades, we've been taught that the modern financial system is designed to protect our wealth, provide access, and ensure liquidity. We assume that the dollar in our pocket, the balance on our online banking app, and the investments we've made are immediately available when needed. But history and structural analysis tell a very different story. In 1929, millions saw their savings vanish almost overnight during the Great Depression, a brutal lesson in the fragility of financial systems. Fast forward nearly a century to 2026, and while the mechanisms appear safer, the underlying truth is far more complex. Modern banking regulations, digital asset structures, and investment instruments create an environment where access to capital is controlled, restricted, and sometimes illusionary. The collapse of 1929 was about money disappearing. Today, it is about money being trapped in invisible chains. We live in a world where liquidity is conditional, subject to regulatory frameworks, market confidence, and institutional priorities. A bank may remain solvent, and yet your ability to withdraw or utilize funds could be curtailed by systemic stress, government policies, or technological constraints. Retirement accounts are no longer just savings. They are legal and financial agreements bound by rules that restrict immediate access. Investment vehicles, from mutual funds to ETFs, promise flexibility, but they operate under redemption windows, lockups, and market conditions that can freeze assets during crises. In essence, your money is no longer just a personal resource. It is a claim on a larger system that has the power to limit, delay, or even deny its use. And while we've become accustomed to thinking that money is liquid, the truth is more nuanced. Liquidity is conditional, contingent, and often illusory. This is the hidden prison of modern money, a structure carefully engineered over decades, reinforced by regulations, policies, and market psychology. As we explore this, it becomes clear that understanding the architecture is not just an academic exercise. It is essential to protecting wealth and navigating the next financial storm. The evolution of money from 1929 to 2026 reflects more than just technological advancement. It reflects a shift in power, control, and systemic complexity. In 1929, cash and bank deposits were largely tangible, and while banks failed, individuals could sometimes access small portions of their savings through personal networks or alternative mechanisms. Today, wealth is layered in instruments designed for growth, risk management, and tax efficiency, yet these very structures obscure immediate access. Retirement accounts, for instance, are legally protected to encourage long-term saving, but they introduce constraints that can prevent withdrawals during times of crisis. Mutual funds and ETFs, which promise liquidity and flexibility, operate under market-driven rules. Fund managers can restrict redemptions, markets can become illiquid, and securities can fail to trade at fair value. Moreover, modern banking systems rely heavily on digital infrastructure. While convenient, these systems centralize control. A cyber attack, systemic failure, or policy intervention can temporarily lock funds in ways unimaginable in 1929. Regulations such as Basel III, Dodd-Frank, and other prudential frameworks are designed to stabilize institutions, but they also impose limits that indirectly impact individuals' access. In other words, safety for the system can mean reduced freedom for the account holder. The system prioritizes resilience of the network over the immediate control of individual deposits. And this is not a flaw, it is a design feature. Banks are required to maintain capital ratios, manage liquidity buffers, and follow protocols that ensure solvency. But these protocols are often invisible to customers until a crisis exposes them. The more the system seeks stability, the more it controls the flow of capital. Our money is effectively placed in a carefully managed ecosystem, one in which every transaction, every withdrawal, and every redemption is part of a network that can be constrained in extraordinary circumstances. Investment structures compound this complexity. Retirement accounts, mutual funds, ETFs, hedge funds, and private equity vehicles are all intermediaries between you and your money. Each layer adds rules, restrictions, and dependencies. Consider an ETF. It trades like a stock, offering the illusion of liquidity. Yet the underlying securities might not be immediately convertible to cash without market impact. During market stress, redemptions can be suspended, prices can fluctuate dramatically, and what seemed liquid can become effectively locked. Similarly, hedge funds and private equity require investors to commit capital for extended periods, often years, making funds inaccessible even when declared investable. In this sense, modern money is less about possession and more about a claim that can be deferred, restricted, or managed externally. The digital transformation of banking further reinforces this dynamic. Transactions are instantaneous, balances appear real-time, but the actual movement of value is bound by the rules of the system, network protocols, and regulatory oversight. A bank may appear solvent, but a sudden systemic shock could impose withdrawal limits or delay payments, effectively trapping money temporarily. Historical parallels help contextualize this. In 1929, people lost wealth due to bank failures and runs. In 2026, the risk is often access control rather than disappearance. But the consequences, missed opportunities, inability to pay obligations, or financial paralysis can be equally devastating. The hidden prison is, therefore, less visible than collapsing banks, but potentially just as impactful. And, as the system evolves, these mechanisms become more sophisticated, designed to prevent catastrophic failures, but inadvertently increasing dependence on centralized authority. The illusion of control is compelling, but fragile. Central banks play a critical role in shaping this invisible cage. Through monetary policy, quantitative easing, and digital financial oversight, they control the incentives and constraints that govern liquidity. Interest rates, reserve requirements, and asset purchase programs influence how money flows through banks, funds, and ultimately individual accounts. When central banks raise rates, the cost of liquidity rises, reducing access to cheap credit. When they purchase bonds, long-term yields fall, altering the risk-return profile of savings and investments. These interventions are essential for macroeconomic stability, but they also subtly manipulate the conditions under which money is available. From the perspective of the individual saver, these forces are opaque, operating behind layers of financial engineering. Even sophisticated investors can misinterpret the effects until systemic stress exposes the limitations. The interplay between regulation, central bank policy, and investment structures creates a situation in which the user believes they control their money. But access is mediated through a complex lattice of rules and contingencies. The result is that, in the event of a financial crisis, money is still there in numerical terms, but operationally it can be trapped, delayed, or constrained. Unlike 1929, where the system failed physically, today it fails procedurally. And yet, the outcome for the individual may feel just as catastrophic. Inability to withdraw, transfer, or deploy capital when it is most needed. Understanding this distinction is essential to both risk management and financial literacy. Historical patterns illuminate the stakes. In 1929, failure was sudden and brutal. The collapse of banks turned accessible deposits into vapor. Modern crises are slower, often concealed by layers of policy and financial innovation. The financial instruments designed to provide flexibility, pension funds, mutual funds, ETFs, create a perception of liquidity. But during stress, these same instruments become restrictive. Redemption gates, market freezes, and regulatory intervention can all prevent immediate access. In effect, the modern saver experiences a liquidity mirage. Wealth exists on paper but cannot be mobilized instantly. And the more sophisticated the system, the more elegant the constraints. This is why the hidden prison is so insidious. It is not dramatic in the way a bank run is. It is subtle, procedural, and embedded in every layer of the financial architecture. By the time the average individual recognizes the limitation, the crisis has already absorbed the shock, leaving the person exposed. Policy measures intended to prevent catastrophe for the system create frustration and risk for the user. This dichotomy, system stability versus individual freedom, is the defining characteristic of the modern financial prison. Recognizing this, educating oneself, and preparing for constraints are essential steps in navigating the financial landscape. So what can be done? Awareness is the first step. Understanding how money flows through banks, funds, and regulatory frameworks is crucial. Diversification, liquidity management, and comprehension of account restrictions become survival tools. The hidden prison of modern money is not a conspiracy. It is the logical evolution of a complex financial ecosystem designed to maintain stability at scale. Yet this evolution comes at a cost: your perceived control over your wealth. As we approach 2026, the lessons of history are clear. Whether in 1929 or today, the system will always act in its own interest first. The modern saver must act strategically, acknowledging that liquidity is conditional and access is mediated. If you found this exploration valuable, hit the like button and subscribe for more deep dives into the structures shaping wealth, power, and economic reality. Share this video with anyone who believes their money is fully under their control. The truth is far more complex. Understanding the hidden prison is not just intellectual curiosity. It is survival in a system designed for efficiency, stability, and ultimately, control.